Well, hello there, and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton, the Inflation Guy. I am your host, and today on the podcast, once again, I've got a lot of things to get to. I really wanted to get to the Fort Knox audit story, but I think that's going to have to wait. The main thing today is the most favored nation concept, which is a concept from Donald Trump's first term that's important to understand for pharmaceutical and potentially other industries, but mainly pharma. Before we get into that, a word from our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. You can find their entire lineup of ETFs at simplify.us/ETFs. Now, before we get to the most favored nation stuff, there are a couple of other quick topics. Again, there's just so much stuff going on these days, so much stuff having to do with inflation and other topics that, you know, if I produce this podcast once a week, I just can't have just one topic. I have to talk about other stuff. So I've got a couple of little notes here. First, the Atlanta Fed wage growth tracker was released this last week and rose to 4.3% on a rolling 3-month basis from 4.1% the prior month. Now, I'm just taking administrative notice of this fact. The wage growth tracker peaked at 6.7% way back in 2022, and it's been steadily coming down. And over the long haul, it tends to settle about 0.5% above median CPI. So right about here, around 4.3, 4.1, 4.5 is where I'd expect it to run into difficulty declining further. If I'm right, in median CPI should end up in the high threes. Last week in the CPI report, I noted that kind of everything is converging on 3.5% right now. And so maybe we get wage growth down to 4%. But the point is that now is the time to start watching closely. The wage growth tracker, the Atlanta Fed wage growth tracker, I think is the sort of the best measure of wages out there because it measures only people who were employed 1 year ago and are still employed today. So we're leaving out people who were laid off and new hires, and so you don't run into the compositional problems that you run into with like average hourly earnings from the employment report. So keep an eye on the Atlanta Fed wage growth tracker. Again, wages are important. They follow inflation, but they're an important part of the feedback loop. And so you want to see wages continue to decline if you want to see inflation continue to decline. Obviously, we want wages to be above inflation, wage growth to be above inflation, but we want to see both of those continue to decline if you want inflation to go down. Point two, I'm also taking administrative notice of the jump in the University of Michigan inflation expectations. The long-term, the consumer expectations for long-term inflation, 5 to 10 years, those expectations spiked to 3.9%. That number was 3.2% in January, 3.5% in February, and now it's 3.9% for March. And that's the highest level. So again, this is consumer expectations of inflation of inflation over the next 5 to 10 years. And the last time it was this high was in 1993. Now, this is puzzling, and there doesn't appear to be any really rational explanation for this. It can't be tariffs because tariffs are a one-time price change. The year ahead, the 1 year Michigan inflation expectations jumped from 3.3% in January to 4.9% in March. And that makes some sense in terms of tariffs that you'd expect. Now, normally those numbers track gasoline prices a lot, but right now with all that's going on with tariffs, I would expect short-term expectations to jump a lot. But really it shouldn't move the needle long term, unless you think that every year we're going to just increase tariffs. And if you do think that, then eventually it doesn't take too long before we're not buying anything that's coming in that's subject to tariffs because it's all way too expensive, and then the problem goes away, right? So it's a naturally limited problem. And so it's difficult to figure out why people suddenly think, suddenly raise their expectations for the long-term inflation by that much. So two sub-observations here. One is that expectations don't really matter for inflation. But if you believe that they do, and some in the Fed do, then this should be highly alarming. The second observation is that I think this has to be a media effect. The media has made the imposition of tariffs sound like it's going to cause an imminent depression and imminent hyperinflation simultaneously, when the real answer is that it's pro-growth. Tariffs are pro-growth domestically, and they have a small but positive one-time effect on inflation. Positive meaning it pushes inflation higher, but it's a small effect, and it happens just one time. So there's no rational reason for the spike in long-term inflation expectations. It is wild to me that there is this big of an effect for any reason. I mean, that's a massive change in the 10-year forward price level. Anyway, it's worth watching, not because it'll affect inflation itself, but because it could affect markets. I mean, if you really do think inflation is going to be that high for that long, then prices, the stock market needs to be lower. Multiples should be lots lower. Point 3, I read a note yesterday from Torsten Slok of Apollo. I love Torsten. I read his stuff. I probably agree with him on 70 to 80% of everything he writes, which for me is an enormously high number. I think he's great. But this one had a potential mistake that a lot of people make. And I say potential because he doesn't explicitly draw the lines that would make this an explicit mistake. But the title of the note is Risk Rising of a Foreign Pullback from the S&P 500. And as far as that goes, he's right on. Foreigners are overweight U.S. equities, as he points out. The dollar is declining and the market is overvalued. And so the downside risks as a result of foreign selling are rising. Okay, that's legitimate. But you have to be careful there because it sounds like the old story that, if China sells all of our bonds, interest rates will spike. It's important to remember that if foreigners sell stocks, that means that they'll be holding lots of dollars, right? What are they going to do with the dollars? Okay. So the dollars don't go away. If they've got dollars, they sell stocks, they have dollars, they have to buy something else with dollars. They could sell the dollar. Suppose someone in France sells stocks and he wants out of the dollar altogether. So he sells dollars for euros. The other side of that is that somebody sold euros for dollars. The dollars don't go away. It's important to remember that as long as the U.S. has a large trade deficit, and this is what you should put in bold here, as long as the U.S. has a large trade deficit, it means foreigners are continuing to accumulate dollars. They have to come back into the financial markets somehow. The risk to the stock market and the bond market is that if we succeed in reducing the trade deficit, which it seems like we are, that reduces the flow of dollars that need to be reinvested. And that's okay for markets as long as we're also reducing the budget deficit. And so we stop having to absorb dollars to finance a growing, government debt. So those dollars are no longer have to flow into treasuries. They can flow into private securities. But if we reduce the trade deficit, and we are, but we don't reduce the government deficit, then the flow of dollars into stocks and bonds from foreigners will decline, and that is bad for stocks and bonds. But if foreigners sell stocks, they have to buy something with the dollars they get, okay? So, overarching point, watch the trade deficit and the budget deficit together. Now, the good news for interest rates and stocks is that as of today, or as of yesterday, the Fed is slowing its runoff of its balance sheet, which was another absorption, I guess, and another sort of contraction in that. So the Fed slowing the runoff of the balance sheet is bad for inflation, but that's a story for a different day. In terms of sort of the balance being invested into private U.S. markets, watch the trade deficit, watch the budget deficit, and to some extent, watch the Fed's savings. Point number 4, and then we'll get into most favored nation. If tariffs are so terrible, why does every country in the world do them? And it is, of course, I've talked in this podcast about tariffs and why they're really not that bad if you are the biggest country and you have a small external sector. You may reduce the overall size of the pie, but your slice will get bigger. And so that is actually potentially a net positive. But what's amazing is, and I mentioned this earlier, the media just covers tariffs as like it's the end of the world. And everybody says, oh, the U.S. Is being so terrible for administering all these tariffs. Well, guess what? Every other country in the world does them. So why is it that they're, if it's so bad, if it's so bad for you, why do you keep eating so much of that pie? So I don't know. It's bizarre. There's one advanced country in the world that is in principle able to provide pretty close to 100% of the needs of its citizens with internal production. And ironically, that country is the one that puts the lowest tariffs on supplies from other countries. Now, I'm not saying that our lives would be better if we supplied 100% of our own needs internally. The prices would be a lot higher. But at least in principle, we can. Canada can't. Mexico can't. Doubtful that China can, at least right now. So it's crazy to me. If there's one country that should be able to get away with increasing tariffs from an incredibly low level, it's the United States. But it strikes me that this is one of those things that's good for the goose and not for the gander when looked at this from the standpoint of foreign countries. And from the standpoint of media, anything that Donald Trump does, we hate. So therefore, tariffs bad. So, but anyway, it's just amazing. I just think that sometimes taking a step back and saying, okay, well, let's assume that you're wrong, and see if that works out. And just when everybody has this knee jerk reaction that tariffs bad, and yet you look around and literally every other country in the world has tariffs, and literally a lot higher than our tariffs. You go, okay, I don't really understand then why everyone else can do it, but we can't do it. Okay, on with the show. Pharmaceutical prices, which is also a global, this is actually a global issue here, or what we're going to talk about. Look, I try not to make economic and market predictions very much, and I make economic predictions. I kind of have to in this pod because that's what I'm supposed to do. I don't really like doing it. I try very hard not to make market predictions. I work hard to say, here's my opinion, but what if I'm wrong? And I want to focus more on the story and how to think about the problem than my answer to it. So I always have a narrative, but you, listener, should view that as a framework that you should push against and decide whether you agree or disagree. No hate if you disagree. You can disagree with me. That's fine. I hope that you think the framework that I'm presenting is the right framework, even if I interpret it differently, whether it's tariffs or what we're going to talk about today or anything else. So my job as an analyst, which obviously is not my main job, but on this podcast, my main job is as an analyst, my job is to tell you a story, not necessarily the story, so you can know the right questions to ask. And so some of my podcasts are like that. And today, when I talk about pharmaceutical inflation and the most favored nation status, most favored nation descriptor, it's going to be like that. I don't know what's going to happen, but here's the framework for thinking about it. I initially wrote an article about this, in fact, in mid-2020, and there'll be a link in the show notes, about how Trump was interested in this most favored nation thing. And it never ended up happening because, of course, Trump's term ended, and there wasn't a second term immediately following it, and so it never happened. But Trump is back, and he's doing a lot of things that he wanted to do in the first term, so I would keep an eye out for this. And incidentally, I brought this up a month or two ago when pharmaceutical prices and the CPI in January spiked. And I suspect that part of that was because pharmaceutical companies wanted to get, and wholesalers or whatever, wanted to get ahead of the potential for some sort of regulation to push down pharmaceutical prices. So, but let's talk about one particular policy. So Trump has in the past talked about having a most favored nation clause in the pricing of pharmaceuticals. What is a most favored nation clause? It's a clause that customer A demands as a condition for buying, and it's a guarantee that no other customer will get lower prices. There was, I don't know if this is true, but I'd heard a rumor a while back that Amazon had demanded this from lots and lots of manufacturers. If you want to sell on Amazon, you can't show a lower price somewhere else. In the investment management industry, it's very common for large investors, state pension funds, for example, to demand that kind of clause in their investment management agreement. So if I, during investments, am charging 30 basis points for a strategy to the person who first invested in this brand new strategy and took the leap of faith, and then CalPERS comes to me and says, hey, we want to invest in that strategy too, then I can't tell them 40 basis points for that strategy, even if that's my real cost to run the strategy. And I was just giving a deal to the first guy. CalPERS has to get 30 basis points because they demand the most favored nation status. And if anyone after CalPERS I offer 25 basis points to, then CalPERS also gets 25 basis points. Now, that's a problem for CalPERS because being so big, in this case, what I would say is I'd say, no, CalPERS, I'm sorry, I'm not going to offer the strategy to you because I'm going to lose too much money in other places. Obviously, this is not a problem in competitive and transparent markets. Okay, so someone buying gasoline doesn't need to make a deal with the gas station that no one else will get a better deal, right? The prices are posted right there by the gas station. And if those prices are too high, then I just go to another gas station. But the pharmaceutical industry is not competitive and it's not transparent. So you have to understand a little bit about the structure of the pharmaceutical industry and how drugs get from Pfizer or whoever to your, into the pill in your hot little hand. Drug manufacturers sell mainly, about 90% of what they sell, goes to three wholesalers, drug wholesalers: AmerisourceBergen, Cardinal Health, and McKesson. Those are the big three wholesalers, and that's 90% of where drug manufacturers sell. Those wholesalers don't sell directly to you. They negotiate prices with what's known as pharmacy benefit management companies, PBMs. Okay, and about 80% of that market of the PBMs is controlled by CVS, Caremark, Express Scripts, and Optum Rx. Okay, and none of those entities I mentioned, the three that control the wholesaling part of the distribution channel, and the three big PBMs, none of them is transparent. And what I mean by that is, if you ask them, hey, what have you charged other customers for this drug? They won't tell you. They won't tell you. If you talk to a PBM, they won't tell you what it costs them to get it from the wholesaler, which wholesaler they bought from. They won't tell you. There's no information. Okay, because it's a competitive advantage, but there's also only three of them in each case, which makes it an oligopoly. All right, so this is why the price that you pay for a drug from a pharmacy on the north side of the street might be totally different, might be 500% different than the price you pay at a pharmacy on the south side of the street, right? So you go and you buy Lipitor on one, at one pharmacy, and then you go and buy Lipitor from another pharmacy, and the difference could be 5 or 6 times. Okay, it could be just massive multiples of difference. as an aside, back in 2018 and 2019, something like that, I teamed up with another person to try and create a deliverable pharmaceutical futures contract. So you could have a futures contract on statins, on a generic statin, and so you would actually deliver a generic statin, which would have given you tremendous transparency and another source for getting that distribution. The pushback was incredible. To do that, we kind of needed somebody up the chain to buy into it, and nobody would buy into it, and it never went anywhere. So the industry is highly opaque, not competitive at all, and Americans often pay many times what a customer in another country will pay for the same drug. And that naturally irks President Trump, who tends to get annoyed by things like that. So you can see the problem, and you can see the proposed solution that Trump says, hey, you've got this opaque system, huge price differentials, and especially differentials against Americans. So we're going to have this most favored nation clause. You can't charge us more than you charge, the lowest price you charge anybody else. You sell cheaply in India, you have to sell cheaply in Indiana. It makes sense, at least emotionally makes sense. And honestly, the manufacturers, wholesalers, and PBMs haven't done anything to convince everyone that they're on the up and up, and that everything, they're being fair to everybody, and they're making profits, and that's okay, but they're not making they're not raping people to make these profits. They're not making illegal deals or anti-competitive deals. They're not talking to each other and making deals. That would be collusion. That's illegal. But there's only 3 of each of them, and we don't know how they work. So I'm just saying there's reasons to be concerned. But there are some legitimate reasons for differential pricing, and I want to talk about them because they really matter in this case, especially. And one of them is the price elasticity of demand. So let's think about a pharmaceutical company, or you can take this at any level of this distribution channel. Let's start at the free market version. The free market version, let's assume that the marginal cost of the production of a little pill is 0. Okay, so you do your development and then you can produce pills at 0 cost for all intents and purposes. Or at least that there's no difference between the cost of a pill in the United States and the cost of a pill in India. Okay, either way, you produce it in one place, and it's essentially the same cost. Okay, then the firm maximizes profit by solving the problem to maximize independently for each country the price at where the marginal revenue is 0, where in order to sell another pill, the price has to be lowered, right? Because the first person you sell a pill to is the person who needs it the most. They'll pay the most. And the person you sell the next pill to will pay a little bit less. But because you're selling this to retail, you have to lower the price to that second buyer, and so on and so forth. And so you get to the point where if you lower the price another penny, then by lowering the price by a penny to everyone you've already sold to, it ends up costing you net money. And so that's where marginal revenue is 0. And so that's the price. That's as far as you can lower the price. That is the profit maximizing location. Okay, so that point, that price at which you're maximizing a profit in a country is different for each country, and it depends on the demand elasticity for the drug in that country. If the demand for a drug is very elastic, then that market will tend to clear at a lower price, since each incremental decline in price will produce a relatively large increase in incremental quantity demanded. On the other hand, if the demand for a drug is very inelastic, that market will tend to clear at a much higher price, since each additional increase in price will result in the loss of relatively few units of quantity sold. So every country and every drug will have different price elasticities, and based on what else is available in that country and the lifestyle. And so, a lifestyle drug like the little blue pill probably faces a fairly elastic demand in a third world country, while a malarial drug probably does not, probably faces a fairly inelastic demand, whereas a malarial drug in the United States probably faces fairly elastic demand. Competition also matters. So if the EU approves more statin drugs than the Food and Drug Administration in the U.S. does, then the equilibrium price is going to be lower in Europe because there's more competition, more demand elasticity for any given drug. Okay, so that's what I'm going to do if I'm a drug company. I go to each country and I figure out the price that maximizes my revenue in each country. And it turns out that because the U.S. is the wealthiest country in the world, wealthiest big country in the world, that prices are higher here than everywhere else and potentially largely for economic reasons. Okay, so what happens if the administration now makes this problem a joint solving problem? Okay, so the seller, we instituted a most favored nation clause, and now the seller needs to maximize revenue across all the markets simultaneously with one price. And how does it do this? Well, it's going to start with the highest price, just like we did before, right? So we start with the highest price. We started with the highest price we sold to any individual consumer, and then we went to the next consumer that we had to lower a price for, and we said, well, okay, does that net add? When I have to lower that price for everybody, does that net add revenue or does it subtract revenue? So now we start with the highest price, the market that has the highest price, and then we add the incremental market that has the most inelastic demand after that, and see how much the total revenue will increase if the drug seller has to lower the universal price to induce demand in that market. Okay, so we do this problem country by country instead of consumer by consumer. Now, if the U.S. is the highest price country, then doing that may lower the price in the United States, but it will also raise the price in the low priced country, as you go along. And since the lower priced countries probably have more elastic demand than the high priced country, which is suggested by the fact they had lower prices when they were being separately optimized, it's easy to imagine a scenario where the drug company ends up only supplying the high-priced country because the large increases in price, or the large increases in price for other countries essentially eliminate the demand in those countries. Or you have to lower the price enough to get that demand that you lose all your profits in the U.S. Now, any constrained outcome is going to be bad for the seller. Okay, so if I have to do that by country, it's going to be worse for me than if I have to do it consumer by consumer. But it almost certainly will not cause drug prices in the U.S. No, I'll go further. It will not cause drug prices in the U.S. to drop to the price of the lowest country, the lowest priced country that a drug company sells to. Because to do that, you'd have to take such a loss in the United States. You just wouldn't do it. You'd say, well, I'm just not going to sell it to that low-priced country. Okay, Bangladesh. Okay, it's $1 a pill. It's $10 a pill in the U.S. Okay, I'm going to lower it to $1 in the U.S. Guess what? I just lost a tremendous amount of revenue. So instead, what I'm going to do is not sell to Bangladesh. All right, so that's likely what that happens. You probably get slightly lower U.S. drug prices, and you get reduced global distribution of U.S. pharmaceuticals, which means less development of drugs in the U.S. It also might force companies to spin off, independent subsidiaries that license the manufacturing of the drug in different companies. I mean, if one company can't offer 10 different prices, then create 10 different companies which each offers one price. There are ways you can sort of financially engineer around this. It's excellent politics to have such a policy, right? So saying we're going to make it so these drug companies can't rip off Americans so they can supply Bangladesh. That's neat politics. It's not necessarily very good economics. And in principle, it could even increase U.S. drug prices, because when you do allow that price discrimination, any customer that pays more than the variable cost of the product, now we said the variable cost in this case is zero, but it's not quite zero in reality. But any customer who pays more than the variable cost contributes something to the fixed overhead of the company. So a company that understands cost accounting will sometimes sell a product below the total cost per unit as long as it's above the variable cost per unit. So when a U.S. company sells a pill to Norway at a really low price, but above the cost of production, it defrays some of its U.S. overhead, okay? So if a most favored nation clause prevents a company from doing that, and so it sells lots less, many fewer units, then it could potentially need to raise the price of the product in its remaining markets in order to cover that overhead that's not being covered any longer by those consumers. So, in fact, you can even come up with a case, not that hard to do, where it's optimal to sell everywhere except the United States. If the value of the business everywhere else without the constrained pricing is greater than the value of the business with constrained pricing, where the U.S. market is included, you might say, guess what? I'm just not going to sell it in the U.S. Okay, because if I, have to start lowering prices, then I lose more money everywhere else. Now, I think it's obvious if you've listened to this podcast at all in the past, it's obvious I'm no fan of government control of pricing. I just think it almost never works out well. It's difficult for me because clearly the distribution system for drugs is terrible, and it's opaque, and it should be improved. And that's what Trump is aiming at. Okay, one way to do that does not involve screwing around with pricing is to actively encourage competition in the PBM market and the wholesaler space. Pierce the oligopolies that exist on pricing and the oligopolies on information. That's probably better than requiring transparency. Just, give incentives to create these other companies that are going to compete. Create incentives for pharmaceutical companies to distribute to more of these, okay, into more wholesalers. Free markets for generic drugs would probably help too. A futures contract on generic drugs would be a neat idea, but I'd avoid the most favored nation approach. Maybe this time the Trump administration will. Maybe they won't do MFN. Maybe by breaking up the near monopoly that China has on active pharmaceutical ingredients, APIs, the precursor ingredients to a lot of the pharmaceuticals we produce, maybe pharmaceutical companies will play ball, right, on domestic transparency and pricing. Look, Donald, if you make it so that we can create these APIs domestically, or we can get them from a cheaper source than China, or less constrained source, if you'll let us produce them, then we'll give you some more transparency and we'll lower the end price of the end ingredients a little bit, or something like that. I don't know, but I wanted you to understand the MFN circumstance, or the MFN system, because most favored nation is something that you likely will hear about. If you haven't heard about it before, you're likely going to hear about it sometime over the next, let's say during the Donald's term. Probably sometime over the course of this year. And as you look at the CPI for medicinal drugs, you should keep in mind that the pharmaceutical companies know this is lurking in the background. And so some of what may be going on in drug pricing has to do with positioning drug prices so that there is a better negotiation can go on with the Trump administration. So now you know the rest of the story about most favored nation clauses and the pricing of medicinal drugs. And that's all for today's podcast. Another long one. I'm sorry about that, but please, Hopefully you liked it. I thought there was a lot of content here. If you did like it, then subscribe or refer others. If you have any questions or comments, and you may well on this podcast, contact me at inflationguy@enduringinvestments.com. The blog is at inflationguy.blog. I'm on X at inflation_guy. Enduring Investments is where you go for help with treating an inflation problem, and most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.